Welcome to this week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA. We are dropping the hammer on cash flow problems so you can build things that matter. This week's topic is going to be business entity breakdown. We're going to talk about which structures save you the most on taxes. As always, keep in mind, it's not a one size fits all. So, did you ever wonder, is there a way that, your business should be structured? Is there a way that one way or another that I could save money, or save more money one way or another, or, avoid overpaying year over year? So that's what we're going to talk about today. Which structure makes sense? So we're going to break down the different entity types, talk about how they impact your taxes, and we're going to talk about practical, as always, practical tips so that you make sure from in your particular instance that you don't want to leave any money on the table. And again, as I mentioned before, it is not a one size fits all. So let's just think about how it pertains to you and then which one is the best for you. So why does this matter? As always, your entity choice is going to impact your taxes, any other liabilities, your payroll, even how you might grow or potentially sell your business in the end, if that is kind of your end goal down the road. Most people don't ever revisit their structure once they've chosen the structure at the beginning. So I've formed my business, I picked my structure, and I'm stuck with it forever. That's not necessarily the case. When you have major things that happen, for example, your circumstances that change or your revenue grows significantly, you might want to actually think about adjusting your structure. So again, we're going to talk about that today. And then also picking or in fact switching to what is the correct entity structure for you at a moment in time can help to potentially protect your profits, improve your cash flow, and ultimately, minimize your tax liability, which is what we talk about a lot. So let's talk about our first. So we're going to talk about our sole proprietorship or our single member LLC. Why are we lumping those two together? Because the LLC does not exist for tax purposes. The LLC is simply a legal vehicle. You either, there are default tax ways that like default tax types when you are organized as an LLC. So for example, if you are one person in an LLC, you are a single member LLC, you default to being taxed like a sole proprietor does. So that's why we're putting those together. Okay. So why would you go that route? Well, the sole proprietor anyways is easy and inexpensive to set up, right? The LLC unfortunately does require organizational documents. So there is a little bit of an investment there. All of your income is reported on your personal tax return on a Schedule C. So basically, one page on your personal tax return has your revenue and your expenses, and that profit number is what passes through onto the page one of your personal tax return, right? So again, there is no additional tax filing. You're still continuing to file that 1040 like you always have. You're just adding an additional page to it. Now, keep in mind, when you file as a sole proprietor or a single member LLC filing as a sole proprietor, your tax impact is that you are subject to self-employment tax on all of your profits. So you're subject to the 15.3% self-employment tax on the profit for the business, and that profit number is also taxed for income tax purposes. Okay, so you've got two things happening there. Now, who is this best for? This is best for a new business, a small business, a business that is in fact going to stay small. You're just testing out whether you actually want to do this. Maybe it's a hobby and you're not positive if it's something that you want to do a little more full time. This is, in most cases, your sole proprietor is the easiest way to get in. There is not as much compliance as you would once you start to get into these other types of entity structures. So again, new businesses that are staying small, you're testing things out, trying to determine whether or not you want to actually do this business. That is ultimately probably going to be the best way for you to go out of the gate. Now, you also have the option when you are two or more people to have a partnership or if you are two or more people in an LLC, you automatically default to being a partnership, right? So you've got two people, that's what you're going to file. You file a 1065 and you will default to being a partnership. Now, when you have an LLC, there are other options you can choose. You can choose to be a different type of entity. We're not talking about that yet. Just in this particular case, two or more people is a partnership, or two or more people in an LLC are going to default to be a partnership. So, what does that mean? Your profit and losses are going to pass through, okay, to the owners on each of those partners' personal tax returns. So again, if you have a $100,000 profit coming through this partnership, two partners, 50,000 on one, 50 on the other, that profit, that $50,000 profit ends up on each of the partners' tax returns. Okay. Very kind of simple, generic terms. It passes through. So you hear us talking about partnerships being a pass-through entity. It passes through to the owner. So the partnership is flexible for profit sharing. So you could have different types of profit structures with the partners depending on what partners are doing in the business. But you need to have a great partnership agreement. You actually have to have a partnership agreement. Unfortunately, far too often we see where people get into business together, there is no partnership agreement. Who does what, when, why, and where, unfortunately, we start to see the biggest challenges is when one person decides they want to exit. If there is no partnership agreement that speaks to how one person exits this arrangement, you tend to run into your challenges. So you want to make sure that you have a good partnership agreement in place. Again, no one wants to see a partnership dissolve, but unfortunately, it happens far too often. You want to make sure you protect yourself. There's a clear understanding of who does what in this partnership so that you don't run into any challenges. So what's your tax impact when you're a partner in a partnership? So your partners, again, the income passes through to the owners, right, to the partners on their personal tax return. Your partners are also going to be subject to self-employment tax. Unless there is a specific type of partnership structure, for example, a limited partnership. Again, we're not going to dig into that. We're not going to pull that one apart. What I will just say is you're going to be subject to self-employment tax when you are a partner. So again, it's the same idea as what's happening when you're a sole proprietor. While it's passing through this entity, the reality is what happens on your personal return is going to look very similar to what happens when you are filing as a sole proprietor. So who is this best for? This is best for businesses with multiple owners if you want flexibility in the ownership, in what each person is going to do. Is there going to be a partner who's not as involved as another? That you're not going to share all of the liabilities equally and so on. And again, you're not sharing in the liability, the complexity, everything related to having this business. It's a little bit easier for the multiple owners to kind of play around with what it is they're going to do in the business, how, again, the profits and expenses are going to pass through to them or not. So you have a little more flexibility there. So that's a really good option if you've got multiple owners doing multiple different types of things in the business, but it's not an equal. It's not a 50-50. It's not a 1/3, 1/3, 1/3, right? It gives you the opportunity to kind of play with that structure a little bit and have certain individuals taxed a little bit differently. All right, so next we're going to talk about the S Corp. Now, the S Corp, you can actually organize to be an S corporation, or as we've talked about with the LLC, because it doesn't exist for tax purposes, you have the ability to do something that's called check the box, and you can elect to file as an S corp if you are an LLC. So you have a couple of different options there. Your S corp is how you've organized from day one, or if you were an LLC, somewhere along the line, you may choose to elect to be an S corp for tax purposes. So again, how you are taxed is going to be the same regardless if you started out as an S or if you're an LLC electing to be an S. Okay, so what does that mean? So again, this again is going to be this pass through taxation similar to your partnership, right? So all the profits are going to flow to the owner or owners' personal tax return. So in this particular case, there's not going to be any double taxation. Okay. Now the advantage is you can begin to split your income, what you've earned through this from this business, between your salary. Okay, so that's going to be subject to payroll taxes in the business. The business will get to take the payroll taxes as a deduction, and your distribution. So that's a distribution of profits that you've already earned. Again, the distributions are not going to be subject to self-employment tax. You just have to be careful with your distributions. You don't want to take distributions in excess of any basis that you have in your stock. Again, this is not the place where we're going to talk about that. Just keep in mind, this is where when you start to hear people talk about splitting their income between the salary and the distributions, that's where you have a little bit of flexibility now, right? You have to pay yourself a reasonable compensation as a corporation, right? The owners have to be paid reasonable compensation, but what can you do with the distributions that are coming to you, not subject to self-employment tax? So again, you have a little bit of flexibility there with kind of moving some of the tax around and making the liabilities adjusted a little bit. Again, as I mentioned before, you must pay yourself a reasonable salary, and stay compliant with any of your payroll related filings, filing your quarterly 941s, filing, the W-2s appropriately at year end, and so on and so forth. Reasonable compensation, reasonable salary is going to be based on a number of factors. What part of the country are you located in? What type of business do you have? What are you doing for income? How engaged in the business are you? So on and so forth. So again, that tends to be something that, from our perspective, that we will run an analysis of what reasonable compensation for an owner would be. For example, an owner who is a roofing owner in a New England state, and you're doing $5 million a year in revenues. We would look at that whole picture and determine what is reasonable for that particular scenario. Reasonable comp is not a flat thing, so it's not one size fits all. It's going to be dependent on the type of business you have, where you're located, and what you're doing with it. And so kind of who is this best for? This tends to be a really good option if you are an established business, you have consistent profits. It tends to be kind of a sweet spot for that small to mid-sized business, right? So when we're talking about small business, this is going to be, the roofing contractor that you see, in your neighborhood doing roofing projects, or the electrical contractor, or the HVAC company that comes to your house and does maintenance or installs a brand new system for you, right? That's typically, not all the time, but a lot of time is going to be that small to mid-sized local business, right? So these are really good options for that type of business, for service providers, consultants, contractors. We tend to see the majority of our clients in some type of S Corp scenario. It is usually, at the size that they're at, the best option. It is not the only option. It just happens to be, for many of them, the better option for the size that they're at. So again, like I mentioned, one size does not fit all. You need to look at your own circumstances and what you think you're going to do with your business. So our last one. This is going to be our C Corp, right? So now also, as an LLC, you could also elect to be taxed as a C Corp. So you have that option. You can start out as a C Corp, so you organize that way, or as an LLC who ultimately elects that C Corp. So you have kind of two options there. Okay, so what does that mean? This particular corp is going to be taxed as an entity itself, right? Nothing is passing through to the owners, right? The corporation pays its own tax on its profits, right? Very simple. We're not passing it through to the owner. If we have a $100,000 profit in the business pays the corporate income tax. And that is pretty basic, the simplest. Again, we can get super complex with it, but that's the simplest way that we can explain it. So there is a potential for you to be taxed what we call twice. So the entity itself pays its income tax, but then the entity may in fact give you as an owner dividends. So you might get dividends on an annual basis, right? So for some of you, like you may have acquired stock in some of these really large publicly traded businesses, and maybe once a year you get a dividend check from that corporation, right? It's the same thing when you are the owner of the C Corp, you would pay tax on that dividend. So the business pays tax on its income tax, and then you as the owner are paying the tax on the dividend that you receive. So in some cases they call this kind of double taxation. So it's something that you want to think about when you're looking at this particular structure. So what are the advantages here? A couple different things. So you can offer more fringe benefits, so health insurance, retirement, etc. And there is no self-employment tax on the profits. Again, the entity itself pays its own income tax. C Corp typically is easier to raise capital or to attract investors, right? So that structure, for example, am I going to go out and raise money and look for investors to expand my business? I may want to have a C Corp structure because it's going to be a little bit more appealing to an investor to potentially invest in my business. Who is this best for? This is typically going to be best for your larger businesses. They're reinvesting their profits. Companies that are planning on significant growth or are looking to engage with outside investors, right? So, for example, the big major companies that we are all aware of, those typically are all going to be C corporations, right? So your local electrician or your local plumber may not be a C corp, but they may also be a C corp because it might be the right structure for them depending on what they want to do. So this is not a one size fits all. You really need to look at your personal circumstances, where you are right now, where do you think you want to go with it? And from there, you start to determine what makes sense for the right structure for you in your circumstance at that moment in time. A couple other things that we want to think about, right? What are the rules on the state level? So some states impose a franchise tax, an excise tax, kind of depends on the state. So you want to make sure you understand what the rules are in the state that you are operating in or multiple states you're operating in. And those taxes, excise tax, franchise taxes, are going to be in many cases imposed on specific types of entities. So you just want to make sure you're clear on what those rules are in the states that you're operating in. Other things to think about: really complex or really simple, right? How complex, again, the more complex you get it, there's probably multiple and crazy layers of infrastructure there that are, that compliance that you're paying for on an annual basis. Simplicity, you don't typically have that issue. So something to think about. So LLCs typically are easy to manage. C Corps and S Corps tend to have a little bit more compliance, but you have the opportunities in some cases to unlock a bit of savings or even sometimes a lot of savings. So where is that line between a lot more compliance, paying for that compliance, and our savings? And those are sometimes the ways, the things that we're weighing when we're determining what makes sense for an entity at a moment in time. And ultimately, what are your future goals? What do you want to do with it, right? So you may be at a specific size right now, but where do you want to be in 5 years? And you want to review this regularly because as that changes, you want to make sure that you make adjustments appropriately. Again, for example, you may get into business initially and have no intention of growing maybe too large, but now you've changed your mind and now you want outside investors and you want to be able to do other things. You may need to, in fact, adjust to the structure of the entity. So again, things to think about. It is not a one size fits all, but you're also not trapped with that structure that you picked on day one if 10 years in things have changed significantly. So I'd be curious, drop in the chat, like what type of entity are you using now? Have you ever thought about adjusting the type of entity that you are? Does the entity choice that you made when you started still make sense, right? So again, think about those kinds of things. Drop them in the chat. I'd absolutely love to know what you have to say, and we can see if you are in the correct structure for your business at this moment in time. All right, so what are some things that you can do today? Actionable tips and takeaways for today, right? So one, make sure you review your entity structure. I'd say every 1 to 2 years, especially if your revenue is growing and growing significantly. If you're kind of flat, you probably don't necessarily need to do that. But again, you need to revisit it. It's not a set it and forget it type of thing. Look at it every 1 to 2 years if your revenue is growing and in fact growing pretty significantly. Number two, if you're really profitable, you want to explore whether electing the S Corp status makes sense. Could you reduce your self-employment taxes that you're paying? That might be an opportunity. That tends to be one that we go to pretty quickly with our clients, especially if they are in some sort of LLC structure. The more money that they're making, we tend to kind of go that route pretty quickly when they start to really making a good sum of money and it starts to get expensive in self-employment tax. So we look at that option. Number three, weigh kind of that benefits versus burdens, right? The C Corp may make sense, if you need investors, if you're looking to offer significant investment benefits, if you are looking to maybe offer ownership to your team or to your leadership team, right? Maybe the C Corp structure is more appealing, but it just adds a layer of complexity and compliance to it. So you want to make sure you're aware of it. And the last thing, tip number four, always talk about this with your CPA as well as your attorney before you make any kind of change. Because in some cases and in most cases, there's going to be a legal side or a legal reason for things. And there may, in fact, also be a tax reason for it. So we don't want to see somebody make an adjustment that they don't need to make. Sometimes it can be more expensive for them, not only in like a tax perspective, but again, there's an investment to make all of these changes legally for your business. So you're spending money legally and so on. So you want to make sure that it is the best fit for what you're doing at this time and what you want to do in the future. You want to make sure that aligns. And so those are conversations you really need to be having, not only with your attorney, but your CPA or EA to make sure that everything, corresponds, kind of lives happily together and you're picking the best structure for the type of business that you have. So just to kind of recap, your entity choice is not a set it and forget it, right? It's going to, in some cases, evolve as your business grows. So revisit it every couple of years to make sure you're in the best, structure for yourself at that moment in time. The right structure is going to protect you, is going to get you some tax savings, and is also going to help you with your growth opportunities because you want to make sure when you're growing the way that you want to, and you're not growing into a really, really large tax bill. All right. So I would love to hear from you. If you think about changing your structure, what do you think you want to change it to, right? Drop it in the chat. We'd love to hear from you. As always, we look forward to seeing you here every Friday. Follow us here on Facebook, on YouTube, Instagram, and LinkedIn. We are at The Construction CPA on all. And have a wonderful weekend, and we'll see you next week.